the best of Money Matters. Market View on Money FM 89.3.
You're listening to Market View to Money FM 89.3, and it's now time for Market View, where we take a look at how the Singapore stock market closed for the day, the biggest movers, sectors, and companies to watch to help you better position your portfolios. I'm Alexandra Parada. First, let's take a quick recap of how the STI closed for the day. At the close, the STI closed down at 0.06% at 3,927 points, despite being in the green earlier in the day. In terms of counters to watch today, we have Olam after the agribusiness group announced a $1.8 billion deal to sell at 44.58% stake in Olam Agri to Saudi Agricultural and Livestock Investment Company. Elsewhere, we'll look at Raffles Medical's reported earnings growth, as well as several other Singapore-listed firms that have also released key financial updates. For more market moves and views, joining us today is Willie Keng, founder of the Dividend Titan. Hi, Willie. Welcome to the show.
Hey, Alex. Good to hear from you.
Hi, Willie. Thank you so much for joining us today. Great to hear from you.
Yes, good to hear from you again, Alex.
Okay, so let's start off with the Singapore stock market, Willie. How did the STI fare today, and were there any surprises among the key movers?
Yeah, I mean, if you look at the STI index, it has closed slightly higher. It was up about 0.05%. And I think some of the top movers here includes also Singapore Airlines. You have the Singapore Exchange, the SGX, which was up about 3.9%. I think this comes on from the positive news last week after MAS has announced some of the measures to try to improve the stock market, the local stock market. We also have Mapletree Industrial Trust, which have also supported the performance of the STI index today. Largely, if you see from its recent more positive results after it has announced more steady distribution per unit for its investors, and at the same time continuing to grow its data center business. So overall, it has been quite a cheerful performance for the Straits Times Index, and largely quite positive. I mean, if you think about how the investors' sentiments are.
Okay, so speaking of the STI's movements, looks like the SGX saw its shares reach a morning high of up to 5% after measures were announced to boost the Singapore stock market on February 21st. Could this signal that the moves to revitalize our local stock market will be effective? And what did you make of the measures that were announced?
Yeah, I think that's that's the elephant in the room for today, Alex. If you see, I think it's definitely encouraging to see how the market is getting a boost, and I think this is actually a positive signal after the measures were announced. I mean, number one, you have the MAS looking to launch a $5 billion program where it will try to partner with some of the fund managers to invest in Singapore stocks. At the same time, you also have regulations trying to streamline to make the listing process in the Singapore, the Singapore stock market to be more efficient. So I think these are all very positive points. But, at the end of the day, I think it's not just about injecting a massive amount of cash to expect immediate results. I mean, if you look at how Warren Buffett always says, you can't simply produce a baby in 1 month by getting 9 women pregnant. So it's probably going to take more than just having this large amount of cash injection to help support the stock market. But at the same time, I think we need to understand that what ultimately drives stock market valuations is profits. So company profits drive stock market valuations, and stock market valuations drive more listing. So what this means is that I think, cash injection from the government is one thing, but being able to help many of the Singapore companies grow overseas is one big point. Another is also to leverage on our Singapore brands, products and services, and try to grow overseas in order to be able to expand and grow local companies, which allow local companies to garner better valuations. I think that's one big point here. And one prime example which I can give is, of course, our highly popular Singapore REITs market. Singapore REITs, if you've seen, it has, it's now one of the largest sectors in Asia, and it has attracted REITs to be listed in our local stock exchange. And I think there's something to learn, because if you look at, for instance, our shopping malls, the shopping malls designed and developed by CapitaLand, that has been able to replicate overseas. Many overseas companies are able to actually tap on our expertise in property development, for instance, and are able to actually grow on that. So my personal take on these new measures, I think cash injection is one thing, but also to help local companies to springboard their businesses, their operating model, and scale beyond overseas would allow them to better improve their efficiency and their profitability model, and that would in turn help to grow the listing in Singapore over the long term.
I see. Okay, now let's move on on some of the key movers, starting with Olam. So this $1.8 billion deal represents a significant divestment in Olam Agri. What does this mean for Olam's overall growth, and how are investors reacting to such a move?
Yeah, I mean, this is a positive news. I mean, if you look at Olam, it's one of the largest commodity traders listed on the Singapore Exchange, and selling one of their biggest cocoa and coffee business unit sort of sends a signal that this could actually improve, number one, their valuations. Number two, this also helps to unlock some of the value hidden within their assets. The amount of cash which is able to actually come in would also be able to pay down some of Olam's debt, number one, and number two, being able to actually use the cash flow to be able to grow their business. At the end of the day, as a commodity trader, I think what's important to focus on is the free cash flow of the business. So if they're able to actually monetize some of these assets, I think the strong point is that they are probably able to see growing free cash flow, which allows them to probably see a much better valuation for the commodity traders themselves. One thing which I want to look at for Olam, especially for its overall growth, I think one key area is probably about its monetization of its assets, because I think how investors are reacting to the recent sale of its assets, so far share price haven't really moved that much. I think largely also because even though they have actually sold off one of their coffee and cocoa business for about $1.8 billion, this sort of pales into comparison their asset size. Olam's total assets is roughly about $33 billion, so it's quite a massive amount of assets. What they've actually sold is probably a much smaller business unit in respect to the assets which they have. And I guess as a result of this, so far we haven't really seen much of its share price performance coming from Olam.
I see. Okay, let's move over to Raffles Medical. We saw a 4.3% rise in net profit for the second half, with earnings per share ticking up slightly. We know that healthcare stocks are often seen as a defensive sector, so how do you assess the company's growth trajectory from here? Can we expect a further rise of this company?
Yeah, I mean, this is a good point, Alex. And this is something which I have always been monitoring about Raffles Medical Group. I think they are probably one of the better healthcare businesses listed in Singapore. If you look at their second half year results, profit after tax actually increased about 4.3%. Revenue have grown about 14% year on year for the second half of 2024. However, if you look at the full year business, net profits was still down about 31%, despite revenues have been largely stable. And really, if you see from where they're coming off from, I think a lot of the focus in growing their business is actually coming from China itself, because over the last couple of years, investors are expecting Raffles Medical to be able to expand and grow their China hospitals profitably. But so far, only their Beijing hospitals have proven to be profitable. They have two other hospitals in Chongqing and Shanghai. I think that still remains to be seen for profitability. As a result, I think that has sort of caused some sort of disappointment in the share price, even though they have reported pretty healthy results. If you look at Raffles, there's two things which I will tend to focus on. Number one is their China segment business, which I shared earlier. The second one is their operating efficiency. So Raffles Medical Group, over the last 10 years, they have actually almost doubled their revenues, which is great. But for net profits, in terms of their net profit, it hasn't really grown the same amount as their revenues, largely because of an increase in their operating cost over the last couple of years. So where I will focus on as an investor is also looking at the operating efficiency of Raffles Medical Group. And if they're able to control their operating costs, if they're able to actually maintain their operating margins or even improve their operating margins, I think that would be a strong support for its overall shares performance going forward.
I see. Okay, so if you're just tuning in, we're now speaking to Willie Keng, founder of the Dividend Titan. So also moving to the local market today, some economic news. Singapore's core and headline inflation came in sharply lower than expected in January. What can we make of the recent numbers?
So if you look at inflationary numbers, I think it has slowed sharply to about 0.8% in January. Headline inflation is coming lower than what most economists have estimated, which is about 1.2%. And this was lower than both the 1.7% rate in December and the median forecast of 1.5% by the private sector economists polled by Bloomberg. And this was affected generally from lower inflation from accommodation, from food, and also at the same time, as a result of from the impact of escalating trade frictions, which could potentially impact inflation elsewhere. So the impact on Singapore's import prices would most probably be offset by the disinflationary drags from weaker global demand. And as we are seeing, I think a large part of what we can expect for inflationary pressure going forward could potentially come from the trade tariffs, which is meted out by President Donald Trump. And if you see for some of these import prices, that could actually potentially be coming from places like China, Korea, Canada, and Mexico, and even India itself. So a couple of these places could actually lead to a pressure on inflation, and that could actually impact inflation pressures in Singapore.
I see. But while the SDI is in the green today, other benchmarks in Asia drifted as traders refrained from making riskier bets after lackluster economic data spurred a sell-off on Wall Street. In fact, the MSCI Asia Pacific Index slid from Friday's 4-month high. What's triggering the sell-off?
Yeah, I think a large part is really from the trade war, which we have started to see escalating at the start of this year. I mean, if you look at President Trump, he already wants to start addressing China's trade surplus with the US. So he has already meted out the tariffs for Mexico and Canada. He's also trying to put levies on Chinese imports. This is actually a big move after Chinese firms are starting to shift production to some of the surrounding US peripheral, the US to its US neighbors. So Trump is also trying to target countries which have been importing from China as well, and that actually caused an impact to the market performance and investors' performance, the market performance this morning. And on top of that, you also see some of the locally listed Chinese stocks; those have been impacted by some of the trade tariffs, the news of the trade tariffs coming on from this morning.
I see. Now, looking ahead to this week, NVIDIA is due to post their earnings. Investors have started to boost bets that volatility will come back with the tech firm results, the first in a series of events with the potential to send the market into a tailspin. What are you expecting, and what should investors take note of?
This is a very good point, Alex, and it's something which I'm tracking pretty closely. I think all eyes on NVIDIA coming out with their results coming out in the middle of this week. And I think two areas to actually look for. Number one is the amount of the data center business which NVIDIA has. I mean, after DeepSeek was launched earlier this year, I think there are questions surrounding whether there's actually a need to actually produce or invest in a huge amount of data centers, especially for the hyperscalers. And I think NVIDIA's key customers, they have announced that they will significantly raise or increase capex for 2025 for this year. So I think one thing where I'm expecting or where I'm watching is whether NVIDIA is able to still continuing to capture the spending coming from data centers capex. Now, the second thing which I'm also looking at is also the supply constraint surrounding NVIDIA's AI chip business. So far, like the previous quarters which we have seen, there's actually supply constraints coming from NVIDIA's GPU chips. And if this supply constraint continues, you should assume that NVIDIA will continue to sell most or sell all of their chips which they have built over the next 6 to 12 months. So this is also something which I'm looking at pretty closely for NVIDIA.
I see. Well, thank you so much for joining us today, Willie.
Thank you so much for having me on, Alex.
Thank you. That was Willie Keng, founder of the Dividend Titan. This has been Market View on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.